Hi, let's quickly go through this week's data. I have a comment from Warren Buffett. Only an idiot tries to time the market. And his good friend Bolger from Vanguard, he agrees with this. He says, yeah, nobody can time the market. Well, I'm inclined to go with Bender's typical answer to that sort of nonsense. Take a look at Mebane Faber. He wrote article, A Quantitative Approach to Tactical Asset Allocations back in 2006, which was very good. And he's updated it over the years. He's also written a book on the Ivy portfolio covering both Harvard and Yale and how their endowments are run. And he has a very interesting two-level crossover, moving average crossovers that produces his timing. Basically, when the 22-day average of your S&P is above the 220-day S&P, you're in the market. When it's below, you're out of the market. And that's his magic formula, and it works quite well. Here's a look at it since 1993. And the way we say that, the 22-day versus a 220-day moving average. And the long line here is that 220-day, and the short bouncing around is the 22-day. And whenever the 22 is above, he's in the market, and when it's below, he's out of it. So it made 7.7 versus 8.2. It had a 30% drawdown, but the buy and hold, you'd have had 56% drawdown. So it cuts your drawdown almost. I've got a better one. I'm even more inclined to go with my formula. My very long-term average true range percent run on the QQQ. I did it because it's gangbusters and I just want to show off. So buy and hold on the QQQ would average 13% a year with an 83% drawdown. But the formula we have here for long term, we had a 21% a year return with only an 18.5% drawdown. It took us out of the market here, and we're still out of the market on this very long-term one. I have a shorter version that started in 2006, and we are in the market on that one. And so I'm showing here three of the systems that I've developed over the years. One is just run off the VIX, and it turns out that the 3-month VIX has got the best correlation to the QQQ for setting up a formula. And I'm showing the results of our average true range formula. And another formula is the 200 moving average percent on the QQQ. So there's 100 stocks in the NASDAQ 100. At any particular time, there's a certain percentage of them are above their 200-day moving average. And when a crash comes, they drop down to where there's almost none of them above the 200-day moving average. So this is a signal that can go between 0 and 100. And so we just look at, as it goes up and down, is there anything that makes sense that we could jump in and out of the market on? And how does that handle itself as far as a trading system? It turns out there's quite a bit of information you can get from this. Let me start with the blue, which is Warren Buffett, John Bogle, and 99% of all of your advisors. When you look at a Fidelity retirement fund and you say, I'm going to retire in 2050 or 2030, whatever it is, they're going to give you sliced and diced version of 60/40. It changes just a little bit based on how close you are to retirement. The closer you are to retirement, it moves more and more towards the bond. But this was developed a long time ago. And it turns out bonds aren't that great anymore, but they haven't done anything about it. They still keep selling the same baloney. It's no good. It's terrible, as a matter of fact. 100% S&P, you'd make about, 7, 8% with a 56% drawdown. Cash is 0, 0. This little blue line is a mixture of cash and the S&P. So if you're below this line, that means you're not doing as well as cash mixed with the S&P buy and hold. The 60/40 that used to be so great is not as good as a little bit of cash with your S&P now because the bonds are terrible. And this is what you'll get sold. You'll get sold enough ETFs or mutual funds. If you add them all together, you're going to get the same return as the S&P. They're going to sell you all kinds of bonds. They'll put you in a ladder system and pretend that you're diversified and everything's okay. You got a watered down massive bond mixture with a watered down S&P, and all the little variations between 60/40 plus or minus a little bit is garbage. It's not as good as cash and just being in the market all the time. Everything in orange is a very simple moving average, and they all beat the way out of what these advisors are going to try to sell you. Now, just 200 moving day is quite a bit of in and out of the market, but it does a great job of cutting the risk. A 50-day over 200-day moving average cuts a lot of the cycle out, and it's great. The one that Faber came up with is a 22-day compared to 222, and it's fine. It's very good too. Optimized since 2006, you'd be something like 10 over 185 right now. But I want to draw your attention to the using the VIX, and we're talking about the 3-month VIX here. You can actually come up with a formula where it's just one line. So if you're above this, if the VIX is above this level, go cash. When it's below this level, jump back in. I made it just as simple as possible just to show what it would look like. And it returns 8%, or actually a little better than the S&P, and the risk is almost in half. So that is a very simple formula. I can actually massage it a little bit and give it a smoothing by running it through the commodity channel index over a long period of time, something between 250 to 400 days, something like that, make it a very long-term CCI. And now the signals act quite a bit better. You can get a really good return and even lower drawdown. But then if you say, well, I want to be clever and allow more than one line in your equation and say, it doesn't make sense. When it starts to rise, I want to get out right away. And when it starts to fall, I want to jump back in. And those are two different levels. So you set up a 2-level system, 2-level for buy, 2-level for sale. Let the computer do the work to figure out what would have been a good system, and then backtrack it for a couple of years to see if it holds up. And you can get a unbelievable formula over here using the VIX. Then I show our average true range formula on the S&P. And then I've added 2 on the QQQ, our average true range on the QQQ, and our percent 200 moving day average formula. And they're up here. So everything in green I've developed. And the worst one I have, I think, is still better than anything you can go buy on the market. And these are the ones we follow in our portfolio. We use a combination. I use this as the main one with this as a take a look at it to get long-term benefits to decide whether we're going to move right away or wait another week or so. But basically, the two of them work together to create our signals. So I'm still in the market, but I am getting a little worried. We're up here at a level that is dangerous, and it actually looks a lot like 1932. So sleep well. I'll be up looking for when this bubble does start to pop. Our timer from 2006 is still a buy, and here's the actual detail of every trade it's made. And we're up 66% since we came back in the market. 15 trades in a row, nothing losing money. And this is what it looks like in our chart, making 19% a year with a 12.75 drawdown. This is the actual formula, the buy and sell. The two red lines are sell and the two green lines are buy. So when this line goes up over the red, it's a sale of the buy and sell. The two red lines are sell and the two green lines are buy. So when this line goes up over the red, it's a sell. When it comes back down and crosses the green, that's a buy. So that little clip there, that's when we got out. Now this lazy fall fooled a lot of people. Didn't fool us. We got out just right. I was a little slower coming in. I just wanted to watch it a little bit. But we came back in and we've made tremendous money since then. VIX is still low, which is great for the 401ks that are still out there. Our I don't care portfolio number 2, which is a mixture of short the VIX and long the VIX, but they're different time frames, is still generating cash. There's another look at it. Just to give you an example, this is buy and hold since 4/1/2018 of all these different ETFs. And here's what timing the QQQ with our timers done. And here's the lazy man's I don't care portfolio with just the 100% hedged at all times, short and long the VIX. Well, the guys in the 401ks sell comics, but you're okay on any of these others. Here's what they've looked like over the last 3 months. Timing signals were still 100% buy. Our Russell 1000 is increasing. It's been a buy and still looking good. S&P is still looking good. QQQ is still looking good. So all three are a buy. They're either headed up or level. So that's as good a signal as you're going to get from the 200-day moving average percents. And then there's the stock price at the same time. In the detail of the QQQ 200%, it's been very stable for quite some time here at a really high level and looking flat. Everything's okay. On the volatility, we would be selling when this red line comes up and passes this particular red line, and we're a long ways away from that. So everything's okay. Stay in the market, keep making money. We'll see you next week. Thank you.